So most people think the biggest risk to their wealth is a market crash. In my experience, it's not. Markets are resilient over time. The biggest risk I see again and again is something far quieterly. It's being overexposed to one stock. So nobody plans to be overexposed or end up overexposed to a single company. It usually happens slowly. You work for a successful firm, you receive stock options or shares, the company performs well, you hold on because it feels familiar to you, or you feel loyalty to your past performer. Over time, that one stock becomes a large part of your portfolio. I've seen this happen with names like Nike, Tesla, Netflix, oil companies, and even stocks like Nokia in the past. So the problem is not that these were bad companies. The problem is that your future becomes tied to one outcome. Here's a simple rule. If one stock makes up more than 10 to 20% of your portfolio, you're no longer diversified. You are concentrated. At that point, your financial plan depends on one company, one management team, one industry, and one set of risks that you cannot control. Even great companies, they don't stay great forever. History is very clear on that. Most people believe stocks outperform because they are riskier and risk means reward. But when you look at the data, the story changes. Over the past 25 years, or since the year 2000, the median stock, the typical stock, returned about 59% in total. Over 25 years, that's less than 3%. And in many cases, that's similar to what bonds or treasuries delivered with far less risk. So why does the stock market look so strong overall? And the S&P 500 has returned 435% over the same 25 years. Because a very small group of stocks, roughly the top 4%, they created most of the market's wealth. This feature is true throughout the history of the stock market. So since 2000, companies like Apple, Amazon, Google, Microsoft, Nvidia, Meta, they returned over 1,000%. They pulled up the average, but most stocks never come close to doing that. Here's where most people get caught. They assume that because their stock has done very well, it will continue to do so. The data suggests the opposite. A stock that has already been a huge winner is more likely to underperform going forward than outperform. So that doesn't mean it will fail. It means the odds are no longer in your favor. And when one stock dominates your portfolio, those odds matter. At this point, people usually say, look, I know I'm overexposed, but I can't sell. The tax bill would be huge. And the concern is valid. Capital gains taxes are real, and nobody wants to give up a third of their gain unnecessarily. But here's the mistake. Avoiding taxes doesn't mean that you should unnecessarily accept risk. There are ways that we can reduce concentration without triggering a massive tax event all at once. Selling everything immediately is not the only option. Depending on the situation, there are structured strategies that allow you to 1, reduce single stock risk, 2, diversify gradually, and 3, control or defer capital gains. So in some cases, those strategies will push those capital gains forward indefinitely. So the goal is not to panic. The goal is to move from fragile to resilient, from concentrated to diversified. Concentrated positions, they might feel safe because they are familiar, but familiarity is not diversification. If one stock drives your outcome, your wealth may be far more vulnerable than it appears. The right question isn't, how well has this stock done in the past? It is, what happens to my plan if it doesn't? That's the conversation worth having. Thank you for listening.